to the 10-year Treasury yield. And forget this morning, it's right back down for where it was. Intents and purposes, it collapsed, falling to 2.07%. Remember, Friday it was at 2.14%. What happened? Could we show the hot board? Because I think that that's really kind of stark at the moment. Climbed back up to about 2.1%, and right now we're back down 2.07%, down about 7 basis points. Yields had recovered, but that's gone. Right? We're heading back down. So what does that mean? That means that there's a lot of fear in this market. St. Louis Fed President James Bullard announced sort of around the afternoon that an interest rate cut may be, quote, warranted soon due to trade war and inflation risks. But it was a very bearish call made hours earlier by J.P. Morgan that had investors running for the exits. The bank said it would slash its year-end projection for the 10-year yield from 2.45% to 1.75%. Now, like Bullard, J.P. Morgan is pointing to trade tensions as the spark for the Fed to cut rates twice this year. We got BlackRock taking it a step further, saying the market now expects 3 rate cuts by the end of next year. BlackRock warned it believes the Fed is concerned its current course will not counter a future recession. So maybe we're about to see some dramatic moves. When could we see the first rate cut? What would that do to the 10-year yield? And how can you make money off the possibility? Bring on the floor show, traders. Scott, I'm going to start with you. The Fed's 2-day June meeting begins on the 18th. Bullard said cut soon. Is June too soon?
It all depends, I guess, where the S&P is by that point. If we're all of a sudden 100 handles lower, I know they're not supposed to watch what the market does. I have a feeling they're going to cut sooner than later. If we hold this, just say 2,700 level in the S&P, maybe September. But I think everyone's figuring out that this trade war is not going away. We now have another pressure on tech. So we're going to need some type of rate cut to help stabilize things and help the economy that is showing growth slowing. And this time, the yield curve that inverted, like we saw earlier in the year, that popped right back, has stayed this way. So that's showing some real fear and real growth slowing, at this point where, everyone's taking notice.
Phil, I don't want to sound too many loud alarms because we do have a very tight labor market and wages are rising. However, we did get the ISM Manufacturing Index, and this gives us a sense of the health of manufacturing, and it was for the month of May. Slowest pace of growth in 2.5 years. Is that worrisome?
It is a little bit because, this is what the market has been warning about the slowdown fears, the impact of the trade wars. So we are seeing some signs that it is having an impact. But at the same time, we're still showing growth in that sector. We continue to show growth in that sector. And what we've learned from other reports like this in the past, most of these have been very short terms. We get a bad number and then it turns around and we get a good number. So I think everybody's getting too far ahead of themselves, looking at some of the short-term data, overreacting to this, and I think that the interest rate calls are too much. I don't think the economy is too strong right now to be talking about 3 interest rate cuts, even 2. To be honest with you, even 1 might even be a stretch if we get these talks back on track. The Wall Street Journal says, China wants to talk, Mexico wants to talk, and how many times have we overreacted to trade war headlines only to have the market come back and reverse the other way?
Well, okay, but Alan, right now we just touched session lows, about down 120 points.
Right.
We're down 115 at the moment. I do agree with Phil, but let's just say that we do get more than 1 rate cut. Is there a way to put some Teflon around a portfolio right now, some moves that people could make?
We've got to remember, this has all been self-inflicted. This is going to be self-corrected. Let's remember Mr. Trump had asked for a percentage rate cut a couple weeks back. And so, if we get a couple, we're halfway there. So it's probably going to happen the way he wants it to happen. And these markets can be supported by that. That 2% level is a magnet right now. Mm-hmm. But, 2% doesn't mean anything significant. It's just psychological. We were below 2% in 2016 and for half of 2017, and guess what? The stock market went straight up. So I still think it's going to put the chase for yield back and the money flow back into equities, and I view that as a positive for the markets.
Okay. Scott, Phil, Alan, happy Monday. Thanks for joining us. And we add this question.